Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
Hi there, chaps. Welcome back for another weekly market recap. I'm going to try to make this quick because I have a lot of things to do. It's gonna be a busy weekend. And of course, most likely I'm going to fail at it. But, you know, can't blame a man for trying. So the talks of the week before diving in, from the economic calendar standpoint, not a lot, as we will see, because many of those data points which were supposed to come out, they were initially postponed. And then now we know that a few of them, like I was reading labor market data for the past months, they might come out in aggregate as, you know, October, November altogether, instead of posting the delayed reports for the previous months, which of course they didn't come out because of the shutdown. CPI was scheduled this week and then it was postponed. All right. Then, you know, for the rest, like PMI, retail sales, they should come out, at least standing to what came out of the White House, but we don't know if next week or, you know, throughout the rest of the month of November. So we will see about that. But nonetheless, let's get ready for a lot of stuff to come out and potentially bringing in even more volatility, right? Then what else? We have seen that the AI trade is dead once again. Mainly, you know, these AI scare, I guess it was fueled by the announcements or, you know, the claims or the quotations by, I don't know, Mr. Jensen, CEO of NVIDIA, saying China is probably going to win the AI race. All right. And then we got Sam Altman coming out, CEO of OpenAI, by the way, coming out saying, well, we would actually need the government to backstop the entire thing if it goes south. After all the trillions of capex announced, now are we talking about potentially backstopping it with a public intervention? So, you know, therefore with taxpayers' money? I mean, I thought it was brilliant. It was the future, right? Of course, I'm joking, right? Pun intended. And what else? You know, well, a few Fed speakers, which I think that actually moved the market a lot, but we're going to look at it in a minute. And then what else? Another big talk of the week was this new, brilliant and absurd 50 years mortgage, which, you know, I'm not going to dive into it because I'm sure at this point, all the major financial YouTubers and influencers are all over it. But in a nutshell, it is just straight bullshit, all right? Let alone the fact that, you know, you're going to have to pay a hell of a lot more interest, and therefore the aggregate down payments that you would have to pay, it's going to skyrocket, let alone that it wouldn't move the needle a lot on your average first home that you usually buy in the US. They were talking about what, $200 difference on your monthly payments. Look, if you're not able to afford a home, $200 more or less, it's not going to move the needle, at least in my view. And let alone the fact that it's going to mess around with your house equity curve, therefore, you know, before actually getting into profit from that perspective, it's going to take a bit longer than that. Because if you look at how a loan or a mortgage is amortized, you know, the first, I don't know, on a 50 years loan, maybe the first 10, 15 years of the loan, you're just paying interest. So you're not building up equity. And what's going to happen if the housing market actually dropped, like maybe, I don't know, 4 5%, then you are underwater, which it may not be a lot if you intend to keep the house and keep on paying the mortgage up until, you know, the expiration. But, you know, for many other people involved, which whether you like it or not, they can move the price and influence the housing market. It could change, right? Mainly real estate investors, which could be wiped out. Now, after that, you will also have to consider that the average length of time, you know, that you own a home before actually moving out, relocating, upsizing or downsizing, it's what, 12, 14 years, right? So these 50 years low, why? Just to try to prop housing prices higher so that you don't have an implosion. But as many other things, it's one of those government programs which, maybe good intentions, but it's going to backfire like a lot. Mainly because if you try to artificially boost demand, what's going to happen? Housing prices are going to go up. If they go up, say goodbye to that very tiny $200 spread, positive spread in your favor, right? In time, it's going to be eroded by prices overall going up. But then again, don't want to talk about that a lot. So let's have a look at the economic calendar. There wasn't a lot, obviously. Few things. ADP, the weekly report that they now put out, came in negatively, although, as you can see, we got just 2 releases of that, at least on these economic calendar. Maybe there are more in other places, but that's what I'm rolling for this morning. And then, on a Thursday, we had a few Fed speakers, and the problem with that was that, the next cut, which was supposed to come in December, at least from the standpoint of the forward guidance, it looks like the Fed or, the members, they had a bit of a knockish tone on it, right? But let's have a look at that. First of all, the credit spreads, they are still hovering around this region right here. If you want to be a bit more on the wording side, you might say that now they started to make higher highs and higher lows. Maybe, I don't know. Again, as I said last week, if you zoom out, it's not really something which should be massively worrying for now. Although, again, getting back to last week, we discussed the issues in the credit market, in the money markets, more than anything else. So it is something to consider, right? The break-evens stayed, again, relatively stable, so not a lot of variation here. As for trueflation, PCE for now, it's 2.60 more or less, so dropping a little bit. CPI, again, staying stable this week, not seeing a lot of variation here. And, overall, it's printed at 2.5, so still below the official headline CPI. But again, these sort of a trend that you see, is it why the Fed is being a bit more hawkish regarding the December cut? Because look, these are the expectations priced in by Fed funds futures market, and not only you are now leaning a bit more toward a pause, right? But if you check the 1 month earlier read, the cut was given at basically 94%. And 1 week ago, it went down to 67. And now, 1 day ago, so I would assume on Thursday, it was at 50%. And on Friday, it dropped to 44. So take it as you like. I think, the end of the day, they should be cutting. But maybe, the path to get there, it's going to be a bit more insidious. And bear in mind that this chart right here, it's going to change a lot depending on one single announcement or one single quote taken out of context, right? The market right now, it's all over the place with these cuts, right? GDP now 4%, although again, not really reliable in my view. And I was reading on Financial Jewess just the other day, I think it was Wednesday or Thursday, that, during that White House press conference where they announced, the new schedule for the economic data releases, they also said, well, at the end of the day, for the entirety of 2025, we project GDP to come out at and around 2%. So, this 4% here, I don't know how they're getting to it, but I'm not really trusting it, all right? So that would be it for the part of the introduction and the economic calendar and the overall, look at the week that was. And now we are going to dive into the charts. So having a look at these charts, as usual, let's start out with the DXY, which wasn't surprising at all. We were looking last week at these attempt of breaking out of these key structure swing, was failing, and we said, well, look, it wouldn't be unusual to see something like what we saw in here. So a sharp pullback, and then we will see if we can try to reaccumulate and try again higher, or if we break this tiny little shelf right here, and the DXY actually gets back into the midst of the previous range, which went on for like 3 months. So, you know, for now, nothing really changed. The market, at least this market, moved as expected. And I guess just wait and see for new price information. There's really not a lot to say about currencies, to be completely honest. Conversely, for instance, we've seen the euro popping up a little bit and getting back, testing the previous high, which originated the down move. You know, a little bit of a consideration. The euro actually defended these, what was that? End of July low, right? In here, while the pound, the British pound, actually took that out. So we are still confirming and keep on seeing it. There is this relative weakness of the pound relative to the euro, which again might be explainable with fundamentals, but you know, regardless, there's that. The yen kept on being weak, as you can see, and the dollar Canadian kind of the same. I mean, we got this little bit of a reaction in Monday, Tuesday, and then, you know, a little bit of weakness closing down the week, but overall, we are still trending to the downside for now, at the very least. Instead, the Swiss franc had a pretty good week. It was up all week. So again, it was basically tracking what the euro was doing and what the DXY was doing, right? Other currencies, again, nothing new. They kept on doing whatever they were doing before. So those which were strong, like this one, Chinese yuan or the South African rand, they kept on being strong. The ones which are kind of meh or sideways, like the ruble and the Australian dollar, they kept on being meh, and therefore sideways. And, you know, the one which was absolutely weak, like the Indian rupee, kept on being weak. So again, do you remember what we said? There was an intervention by the central bank, the Indian central bank. What did I tell you? Yeah, usually they're short-lived because the market is stronger than that. So that, I guess that was your intervention. It lasted for what? A week or two? And then we are back to the same levels. So, I mean, I don't know. You do what you want with that, but I usually am not a huge subscriber to, you know, the long-term effects of those interventions, all right? So let's move into oil, which, you know, at the end of the day, although it might seem that a lot actually happened, but when you zoom out on a weekly time frame, we just went nowhere, right? Because again, this is the weekly open on Monday, right here, and we basically close right around there, right? Slightly positive, but overall up Monday, Tuesday, massively down on Wednesday, and we completely pulled back Thursday, Friday. So ranging behavior, two-tape market, nothing really conclusive. If not, I mean, gotta call it spade to spade. If not that, we are now working on a lower highs, a lower low type of framework. We got the retest of this previous level, which was relevant in the past. And on this most recent down candle, we bounced off of this level, which was kind of resistance on the way down, and it was impulsively broken. Now that we reapproach that, it offered up a good bounce. For now, I mean, I don't really have a lot to say about oil. If you remember, I shifted to, you know, bearish overall to maybe a bit neutral, right? But, you know, the way it's moving right now, it's just confirming that at the end of the day, it's not really going anywhere. We are basically at the same price we were at the end of October, October 23rd. So, yeah, not a lot changed. I think at a point, this market will shine. Like it's just a cyclical thing, in my view. There will be a point where it's gonna feel good to be in oil, because let's zoom out on the weekly time frame, right? Because it's hard for a market like this to keep on staying bearish for such a long period of time, right? And most of it's gonna be due to macroeconomics and fundamentals. But I think especially getting into next year, I would bet that maybe oil will at least try to shift this current long-term posture, right? We'll see. It's kind of the same thing, right? What was completely smashed and brutalized last year, probably it's gonna see a little bit of a rebound the following year, and in reverse for something which was massively appreciating this year, right? Maybe next year it's not gonna see the same returns, right? It's always the same type of market rotations, which they work on a week by week, month by month, quarter by quarter base, and they often works on a year by year or a period by period. So we will see, right? Let's have a look at gold. Interesting gold. Now, I guess people were a bit excited about this huge Monday open, and then we kept on rallying in Tuesday and Wednesday, and we got a Thursday a reversal with continuation into Friday. So a few things, first and foremost. So structurally or technically, whatever, we just tried to basically retest this kind of an apex right here. It doesn't look as precise on the daily. Maybe if you zoom in on a 4-hour, what do you get? Yeah, it's actually kind of precise. I mean, we basically retested the last shelf right here, right? Which fueled the attempt of breaking out for new highs and then failed miserably. So we just got back into it. And we are, so far, rejected from there. So, that would be one thing. Now, getting back down, it's a much better phrasing. We are now basically holding up the previous, if you remember, support, broken, resistance. Now again, flipped. Is it gonna act as support now? Look, I think it's one of those things where at this precise moment in time, I wouldn't have a strong bias on gold either way. Because again, we established a high and we established a low. So for me, if you remember my videos of the past, I've always said, look, when these run over, right, it doesn't necessarily mean that it's gonna pull back massively or, but we might see something similar to what we've seen here. Now, am I saying this is the beginning of that and we are gonna keep on trading in this range for another 2 months? I don't know. I mean, honestly, I don't know. But at the same time, it's not something that you can discard. And as you've seen on the 4 hours, right, when you have a sharp impulse, which is, getting back against what was the previous apex from where the reversal actually happened, yeah, I mean, it is tradable in the very short term, so maybe intra-week, but, just tame your enthusiasm, right? Because as you can see, at least at the very first pass, at the very first retest, it can hit a huge pocket of resistance. So this level below current market price could be interesting. That was the last weekly open. Huge impulse up. The candle is particularly thick. There are not a lot of shadows or wicks either to the downside or the upside. So, if ever we retest this point of release, it could offer up again another tradable opportunity. We're talking still intra-week, mind you, right? But for the rest, I think for now it's kind of in a limbo. I wouldn't be so bullish unless we can make another high and confirming these as a higher low. So maybe we can establish a new bullish trend. Same as, or wouldn't be that bearish unless we break this floor right here at and around 3,900, so to speak. So the entire area right here. And below that, we would have this other one for potentially a tiny bounce in here. We will see. But for now, again, kind of like oil, I would maintain a cautious approach to gold. Not to say that it's something that you should stop considering, because, at the end of the day, it's holding up relatively well, considering the huge run it got, the pullback, which was what, 10, 12% from peak to trough, was what, 11.3 if we are looking at futures. Remember, spot price could be different, right? But, we are still hovering around it. So we are still above 4,000, which is obviously a big psychological level. And at the end of the day, we are what? 7% shy of the highs, more or less. So considering how volatile it got recently, it could cut both ways, right? Volatility cuts both ways. So it wouldn't be so incredible to see it trying to retest the highs, and at the same time, getting back to retest the lows and see if this new dealing range can hold wouldn't be surprising either. So again, neutrality for me, at least again in the very short term. Then we will see. Now, let's hurt ourselves for a little while. Let's have a look at Bitcoin. And yeah, I mean, it was in the cards, right? The assessment was one way or the other. We are probably going to retest the 97 level right here, and it doesn't really matter if we are going into it straight from here, which was last week close, or don't discard a potential pullback and then dropping. Now, as for the pullback, we identified these few levels right here, right? So that was the first one in line with the clean breaking point. There was a second line kind of in the middle, and then we say, we said, well, look, given the volatile nature of the asset, let's just put this one into the cards as well for a much deeper pullback. At the end of the day, we kind of get in the middle, as you can see. So not the first one, not the third, right in the middle. It's like your favorite shower, not too hot, not too cold. All right. And from there, we dropped. Now, funny thing is that, and this is going to be a recurring theme, just so bear in mind this chart, bear in mind this chart for gold. So again, Thursday and Friday, all right? Because we are going to expand on those 2 days when we talk about stocks, right? And we try to add a bit of narrative to it. But again, price was rejected. It started to drop on Monday. But if you check, like, this is a Wednesday candle, right? We tried to bounce off of this area right here, okay? And it was again rejected at the end of the day. Same as we did on a Thursday. Look, we opened up in here, we tried to go higher, and we were rejected. And then, of course, after that, Friday was just straight out continuation into the weekly close, at least for the regular trading week. It is interesting because, as we will see, Thursday and Friday, that's where the tone actually shifted and tilted to a bit more of a bearish posture, right? At least, maybe not really the tone of the market, but the narrative, so to speak, right? Just try to piece the pieces together, getting back to the beginning and what the Fed was talking about, okay? Now, the level actually didn't really hold, right? I mean, we are talking such huge numbers that at the end of the day, whether it is 97 or 95-ish, it doesn't really make a huge difference. But it's still very nice to see that although the first level didn't hold, this point of release right here. And, you could start thinking about why. Well, look at this candle, Thursday, the front run of the level that we had. Levels like this one are much more likely to work if price drops into them impulsively. Instead, the way we delivered into that level, if we can zoom in, even on a 4-hour, you should be able to see it, right? So drops, comes back up, drops, comes back up, drops. Right ahead of the level, tiny little pullback, and then it drops into it. So this type of ordered distribution into a level, I don't really like it. If it was something like this, right, very impulsive and consecutive bearish candles, then maybe, yes, the probabilities of the level actually working would have been increased, but you don't want to see the market drifting into the level you are looking at. And it could be, to buy or to maybe place a limit or whatever. But if you want to play a level, it's better if the market is tanking into it, in this case, if you want to buy. Otherwise, if you want to sell, it's better for you if the market is basically skyrocketing into it, right? Now, it was interesting, I said, because at the end of the day, at least for now, we still found support at this previous level, which was where, if you go back in time, we kind of turned the corner back in the days in March 2025. We reclaimed this key swing, all right? We based off of it to fuel this huge rally. So still, it got a play on is offering a little bit of a reaction on, again, on a Saturday morning. Is it going to be meaningful overall? I don't know. What could be meaningful anyway is this. If you zoom out on a weekly time frame like this, what you see, if you have a look at this level right here, this weekly candle to the downside, and you imagine, actually, let's do it. All right. And then you see that this level was completely flipped with strength and momentum on a weekly base when we broke out. And again, we kind of initiated the move which led to new highs. We are now just retesting it on a weekly time frame. So again, could the level fail? Yeah, absolutely. Everything, as we've seen last week with the stock market, as we've seen with gold and a lot of other stuff, levels eventually are just like rules. They're made to be broken eventually, right? But, in the very short term, they're always kind of something to watch out for potential trading opportunity. So I think, we might see a bit more of a bounce. I'm not really, at least for now, I don't think we are going to shoot back up like immediately. But, tiny bounce from here back to, 100K, right? Previous lows. You got this point of release right here, which is the one which is breaking out of the lows, so completely shattering them. Maybe it could be something like what we've seen in here, a little bit of a bounce and then down, maybe, although, we are dealing with a weekly level. So possibly it's not something which is completely unfolding itself in the next week alone. Maybe you need to give it a bit more time, just in case, and just enlarge your outlook to the end of the month of November, and then we'll see. But nonetheless, it's easy to be carried around with the sentiment and with the social media and all the rest, and that goes for everyone, me included. Just the other night before going to bed, I actually posted a pic of I guess it was AI generated, Michael Saylor on a life-saving boat, and on in the background there was a huge boat which was sinking, so like a the abandoning ship theme and all the rest. But yeah, it's most of the times it's just for fun. But again, it's hard to be, immediately bearish when we are retesting a level like this. And again, ahead of the level, we also have this tiny little dodgy candle with a wick to the upside, which is usually something I like, because it's like the market tries to go up, right? If you can imagine the daily time frame. And so it kind of eat up all the liquidity on the sell side in here, and then we push through. So, there wasn't enough rejection in here. And so this is something we should be considered kind of a pivot. And therefore, we are now bouncing off of it. But again, just saying, it could lead to a much prolonged type of a pullback. So bounce in this case. And at the same time, I mean, if we break the 95-ish level, well, I guess at that point, buckle up, because we might get into the 88 or 86 at that point. So this next pocket right in here, right? So one way or the other, it should be a good pivot, right? Now, let's move on very quickly to yields, and then I'm going to reload my trading view. It happens every time I leave my PC turned on all night. I don't know. But yields, they started the week kind of dropping a little bit, and then they came up at the end of the week. Now again, I wouldn't read that much into it yet. That's still going sideways in this range. We don't have any noticeable breaking correlation like I was highlighting previously. So not a lot. I'm not getting something huge out of them. If not, one thing, right? Which is we were operating in a regime of lower highs, lower lows, right? Then it looks, at least for now, that we are not going for new lows, because, we bounced, we had a little bit of a rejection, and then immediately they were put up. Although, again, it's pretty self-explanatory. Just look into this segment right here. We bounced, we came down, and we came back up. So it's kind of the same logic. You would have thought, oh, well, no continuation, no new lows, so maybe this is the time where you can see a reversal. If not, that just 2 or 3 days later, it actually goes down like massively. So again, it's not conclusive that there's nothing in here, because it could very easily be the same thing. Bounce, drop, oh, no new lows, no continuation, then something is changing. And then you wake up, I don't know, next week, and we are down here once again. So you need to wait for the actual confirmations or, shift in the tone of the market, I guess, right? So conversely, of course, the bonds had a little bit of a sideways week. It might seem very bearish if you look at it, especially because, the previous weekly close was here. And of course, it was a week which was negative. At the end of the day, I think we closed down for the week. Yeah, absolutely. But, I mean, still, in the context of holding this previous structure, which was put in on the 2 years, right? Same for the 10 years, which is kind of still hovering around here. The 30 years, of course, they are showing the same signature, but it kind of looked like they could have a bit more to go before, deciding what they want to do, even if they, are set eventually to remain bullish. But it looks like they could test a bit farther down, right? So just wait and see, especially, this market is going to move a lot depending on what the Fed it's communicating, right? And again, what they said is, we are not sure about this December cut. And, the Fed Watch tool is kind of confirming it, but we will see. I keep on thinking, again, as I said in the past, that on one side, they know they need to stop QT. But on the other side, maybe this hawkish talking, it's just to prevent the markets to just go nuts, right? Because imagine now we are cutting rates, and at the same time, we are ending QT, which means that in a matter of months after that, we will be back to actually performing QE. Or another form of, not QE, but which is really QE. It's just that we can't actually label that the same way, because otherwise people are going to think that we are printing money. And since we were unable to get back to the inflation target of 2%, we don't want people to have their inflation expectations being unanchored, right? So it could be some sort of a forward guidance type of a tool to do what they need to do mechanically and structurally, but at the same time to keep the market at bay, right? Or, to curb the potential enthusiasm of the market. And again, as we are going to find out by checking the equity market, I guess so far it worked. Let's just hope they don't get to the point when it's working too much. All right. So brief pause, and then we are going to finish off with the equity market as usual. So the equity market was particularly volatile, but I want to start out where we left off last week, which is kind of, the heat map. Because again, you see a lot of mixed bag results, right? So, we are looking at some red. And again, Meta, Google, Oracle, Broadcom. But this time around, we are looking at a little bit of a green in Apple, Microsoft. So, many of the big caps are actually down for the week. And again, the index is down. So that is, it's natural. But I'm still thinking we are in a rotation. Now, the point would be, okay, so if you say it's a rotation, eventually it should resolve itself the same way the previous rotations, because we had many others in the past, just over the last 2-3 years, right? So it should resolve the same way. And at the end of the day, it might take a week, it might take a month, but, the bullish trend should be intact. Conceptually, that's the thing. Although, again, you need to find a point where it's not really a short-term rotation in order to wear off a little bit of overbought conditions in a few names, which, by the way, are those which are holding up the index. If you remember our discussion about the breadth of the market and, the concentration issue, you need to find a point where, wait, this is not the same process. Because, yeah, sure, those sectors, like could be the technology sector, right? The prime example, right? Those sectors which were supposed to wear off that overbought condition, they did it, but now they keep on dropping. But all the other sectors which are kind of bouncing while these, market breadth was improving, while things were getting back to a little bit more of a balance, now even those sectors which saw a temporary appreciation, now they're falling what the big caps are doing. So, basically what you need to look for is the drop getting generalized or getting broader? Is it expanding to the entirety of the market? That would be the thing where at this point you say, well, I mean, it's not a rotation anymore. Everyone is selling everything at this point, right? Because again, we've been here last week, but look at the last 5 days. So could be the last week. Again, what you see is that technology is down slightly, though. Although you could say flat, more or less, at least standing to this one, right? And you see industrials being down, financials being down, discretionary being down a lot. I mean, they are the worst of the week. But then, I mean, have you checked healthcare? Now, again, probably you don't remember because at this point, I guess it's 2 months old. But we were highlighting the possibility of healthcare to benefiting a lot from a potential rotation into the future. It took like 50, 60 days, but we got there. I don't even remember the particular video where I hinted at that, but this is it, right? Materials, they're positive. Energy, again, it's positive, right? Staples, kind of positive, yeah. So again, it's not that type of market where everyone is liquidating everything. So there is still hope, in my view, for a year end, which might lean on the bullish side and all the narrative about the Santa rally and all the rest. Just bear in mind, okay? Now we might see a little bit of weakness in the beginning of November, all right? Then usually, and again, we are still talking statistics and seasonality and all the rest, so don't take it literally, but we might see throughout the end of the month with Thanksgiving and, a holiday season starting up, a bit of a recover from the market. Then probably the beginning of December, especially the first week, maybe 2 weeks, you're going to have your mutual funds distribution for the year. So if they have to distribute the returns to the holders, the clients, they are probably going to liquidate a little bit. So maybe a tiny weakness the beginning of December. And from there, if everything goes to, according to the usual schedule, you should see the Santa rally. But we will talk about it when we get there. But just as a reference point, right? I was saving it for later, but, this is it, basically. So you see that November, historically, you could have a little bit of weakness in the initial stages of the month. So we are just in the middle of it now. But then, the ending part, getting into the festivity, it should kind of be good. And again, you see the beginning of December, it drops a little bit of weakness because of what I just described. And then we got the Santa rally. Now, again, remember, this is a 20-year range, okay? So it doesn't necessarily mean that it's going to play out like this every single time, right? I don't trade seasonality per se, but it might be a useful tool to keep on monitoring and assessing the market on a day by day, week by week, and looking at the fact, are we in line with seasonality? Or the market is not doing what is historically supposed to do. So something's up with that. Let me check. Let me see what did I miss? Or what happened this week, last week, which could throw a dent in this type of pattern, right? So that would be it. Now, getting into the actual charts. So this is what the market did. So we bounced on a Friday, pretty good bounce. Then we gapped up at the beginning of the week, and Monday kept on pushing higher, getting into Tuesday. Even Tuesday was kind of on the positive side. A little bit of a drop in the overnight session, and then the US session comes up, and we keep on pushing. And up until this point, you might have said, oh, look, here we go again, buying the dip mentality and all the rest. And then I think we got a few good news coming out of AI. I think it was AMD, which announced maybe even more investments in AI or some other partners. I don't know. But I remember reading there was something good coming out of AMD. So again, we did fantastically. That was a huge buying opportunity. So we kept on rallying up until the point, as I was saying, we got into Wednesday, first and foremost, and the market, it just had this little bit of a hiccup in the S&P and same in the NASDAQ. And everything came out in the New York session, right? We tried to bounce basically overnight for me, Asian session in between Wednesday and Thursday. But then as soon as we got into the London session for Thursday, we immediately started back to drop, and the drop just accelerated in the New York session, right? Basically, this is where you had those talks about possibly rate cuts being postponed or maybe opposed in December hitting the news. So the Fed communicating that, well, tame your expectations on these rate cuts. And I guess the market didn't take it positively, obviously. Again, we are just trying to find a reason, right? But as we are going to see in a minute, even before waiting for the Fed to talk about this and that, right? You could have taken a look at this. If you zoom out on the 4-hour, right? What do you see? And again, this is something I'll always check, and especially because in order to maintain my bullish bias, there is one specific thing I want to see, and as I said in the past, that would be the Nasdaq leading, right? Now, what you see instead is the gap up at the beginning of the week. Now, ES futures, they managed to take out this high, which again, it was, there was this top, temporary top, whatever, this apex being put in, right? We broke down, tested back into it, and rejected down. So that was kind of the point where you say this is your key swing for this structure. All right. But at the same time, if you check the same swing, right, what you see is that Nasdaq futures, they were unable to trade above it. So immediately what you know is that NQ is weaker, and you don't need to wait for Thursday or for some fat zombie to communicate this and that. You already had the information you needed in order to really curb your enthusiasm. Because as I said, if you don't see the Nasdaq leading, just be cautious, because that's not usually how it goes when we are massively bullish, right? And again, this thing is reflected in the fact that the strongest, so the S&P, in this case, didn't take out the previous weekly low yet. It could do it next week, absolutely. We could wake up Monday morning and we took it out. Yeah. But again, as a framework, this time around too, it actually worked. Because instead, NQ took out the previous week low. And, we had the Dow going parabolic, which again, still in the framework of these correlations in between assets. When I see the Dow massively shooting up, I know that's never a plus for NQ. And if it's not a plus for NQ, by extension, it's not a plus for the overall market in general. Because again, I want to see NQ leading, right? So that would be the thing, right? So it's nice to keep on doing these thought experiments about, I wonder why the market crashed, right? And then getting back to it and saying, okay, but I can't really trade what the Fed is communicating because, I don't know how the rest of the market will react, right? And they count a hell of a lot more than me, but I don't have a timing mechanism, right? What do I do? As soon as I read the whatever news services I'm using, do I go short? Yeah, but then what happens if before actually dropping, the market bounces like, 100 points? Am I able to hold that short for that much? Well, instead, if you actually look at DTA, you might see things coming, or at least be prepared for scenario, X happening over scenario Z. And you can reassess your expectations and potentially trying to hunt for setups and opportunities in a new direction instead of being hooked to a bias, right? So this is how, the week played out on looking at a lower time frame. Instead, what we got for, the daily time frame, it's Look, I don't want to say that he's bearish completely, but sure as hell, it's not massively bullish, right? So I guess kind of like what we did with oil, at the very least, I'm not saying going, you should go massively bearish, sell the entirety of your portfolio and go hide under a rock for the next 2 years, right? But, it's undeniable that what we are looking at right here is not enticing, right? For now, right? Because we basically made a lower high on a daily base in here for ES and in here for NQ. The Dow's, the Dow made new all-time highs, but remember, the Dow is usually a lagger compared to the rest of the market, right? And look at the Russell. As soon as they said, oh, well, maybe no cuts, the Russell, it's particularly sensitive to interest rates, so it just dropped more than anything else, right? So I think at the end of the day, we didn't really compromise the overall bullish structure of the market. But what I would say, again, pairing it up with the fundamentals and the underpinnings of the market, I think we are well in line with what the seasonality would suggest, which is a bit of weakness in the first part of November. So now the question becomes, what's going to happen next, right? So let's try to highlight a few pivots, right? So first of all, if you look at the S&P, previous weekly low, right? And this lower high. But even more important of the weekly high, I would just say, if we are just able to get back into this range right here, that would be a good start, right? Getting back above 6,800 or 850, if you want to call it that could already be something cool, right? If instead you see, I don't know, some sort of, Monday opens up, you get back into here, got set up in one, no, it should be black, but let me try again. You come back into here and you are rejected, no cool, right? You want to see this level being reclaimed, in my view, right? So that would be it for yes. NQ already took out the previous weekly high. So again, continuation below here, that would be bad. And I think at that point, it could open up the door for a much deeper pullback, basically below 24,000 at this point, because you have this swing right here. And then what you would have is this structure right here, which is 23,800. 800. I usually like those 2s, those 4s, those 80s. Yeah, I do like that. To the upside, again, you could look at the same daily lower low, but even in here, right, at least getting back above 25,500, again, round number, right? And this point of release right here, which is more or less 130 points above it. But again, at least, you don't want to see this, essentially, right? Testing to it and rejection. Because at that point, these lows are already weak. The first one was violated. So how much liquidity do you think is still resting below these lows, right? I know technically you would have these other ones right here, right? But again, it's the same type of principle. We tested back in the area 2 times already. So if we get back into it, there's not a lot. That we're talking 400, maybe 300 points before targeting the lows below that. So I would be kind of skeptical on these lows. If we breach this area, I think we open up the gates for a much more downside, right? So hopefully it doesn't happen, but we will see. It is just the same point of making a plan for both scenarios, right? So that would kind of be the assessment for both. Now, if you look at it when it loads, obviously, right? One way or the other, we still held the 55 exponential moving average in green. I'm sure if you throw in a simple 50 days moving average, it should be confirmed as held for now. Probably, I guess it should be a bit below the exponential just by the nature of it. You're not looking at a lot of enticing things, right? Because look, now we're using the exponential on the RSI indicator as a resistance point, right? So we are trading below it. We are still kind of in a neutral zone. So again, before getting really oversold and potentially looking for a bounce, it would take even more downside to come. The stochastic is trending down. And even the MACD, it's showing you momentum. It's to the downside for now. On ES, we are particularly close to have that 8 exponential moving average crossing below the 21, which again, that wouldn't be good. And I think NQ already did it on a closing base. I think it did. Yeah. I mean, you would need to zoom in like a lot, but it kind of did. Is it massively important? Well, again, those are just averages, right? So don't overlook into it. But, it could be something that some people are actually watching. And especially algos are trading most of the time that they're trading off of those crosses. So just bear in mind. Now, look, I think, again, the market could very easily, again, fool everyone around with, I don't know, another massively impulsive move up, opening up the week for then being faded again. Same as it could open down for the week, but holding around these lows and then trying to retest a little bit more to the upside. So again, I would shift to neutral and wait and see type of mode right now, because I don't like to trade in a market which is going sideways after putting in a little bit of a short-term top like this. I still believe that the chances for a good end of the year are present. So again, as I said, I wouldn't completely go risk off just yet, right? But nonetheless, if anything, the risk is increasing like a lot. And again, it's the same game, right? You remember, last week we were talking about, look, those are your bullish narratives and your reasons to stay bullish. And on the other side, in the other corner of the ring, right, there you get your bearish narratives and your reasons to stay bearish or to shift bearish, right? So it's just a matter of waiting which one of the two is going to prevail and how the market will confirm it. Again, if you're looking at the short-term momentum of the market going something like this, for instance, right? Yeah, we touched back into the most recent type of a trend line, aka momentum on the S&P, but so far we held, right? Same for, it's kind of the same for the NASDAQ, although the test back into it was much more pronounced and the reaction is not as great. So just wait and see to see if this current rotation the market is in is going to resolve itself the same way it did in the past, or if it starts to mutate from a rotation into a slow distribution. Again, one where, yeah, we initially see money flowing by those best performing sector and most extended sectors of the market into, the ones which were a little bit underappreciated, or, they didn't enjoy a lot of consideration from the market, and things get back to normal from a concentration standpoint, right? Which would be healthy for the market over the long run, right? Or if you are seeing money flowing from the overextended, overappreciated stuff, more exuberant stuff, transitioning into what was a little bit out of favor, right? To then eventually completely leave the index, right? Now, again, I don't think we're there yet, but it's still a possibility. It's still a risk, which is worth assessing now more than ever, considering this failure, right, is lower high on the daily, right? So that would be it. Now, look, just for the sake of it, you also have the sectors on TradingView if you want to check them. So, I mean, this is XLK, so this is technology. And again, although the chart of the Nasdaq looks particularly green, at the end of the day, we went massively up. We now pulled back into this previous bulk of liquidity. And for now, we are still holding it, all right? Now, discretionary. For instance, I think discretionary, it's a bit worse because, you know, it looks like a little bit more of a redistribution, right? After the initial distribution, which broke a few swings like this one, and it got back into this point of release right in here. And then what you got is communication, which, to be honest, it looks a little bit like the discretionary side of things. Materials. Well, I mean, sideways, maybe rounded top at the end of it. Financials, yeah, overall sideways, but you know, sideways at a higher level, pretty close to the high, so not that atrocious at the end of it. And as we hinted at, healthcare, I mean, look at that. That was good. Staples. See, you know, if you think the market is going to stay down and to keep on going down for a long period of time, it could be weeks or months. I mean, this is where money should be hiding, right? Staples. Because I guess there are a lot of things that as a consumer you wouldn't keep on buying, but I mean, staples, do you always need something like it? Potentially. Although, yeah, I mean, I guess there are arguments for both sides. And certainly the look of the chart, it's not enticing for now. But maybe it could be just another one of those which didn't see a lot of appreciation in this current rotation. So again, keep an eye out for it. Technically, I don't really like this chart, to be quite honest. But yeah. Industrial, which again, sideways. At a higher level, so which side would you pick? Still good, consolidating at a higher level after being auctioned to a higher level, still good. Or, well, it just means that it has a hell of a lot more to come down if you're bearish, right? Now, utilities, I mean, utilities, they seem kind of good. They had a huge rally and then, you know, they're just drawing back the up move a little bit, so not a hell of a lot to be worried about in this one. Real estate, sideways, although, again, I don't think the real estate market is in a particular good shape now, kind of like the labor market, right? And energy, which, I mean, again, despite oil being kind of flat and operating on that series of lower highs, lower lows on a daily time frame for now, although, you know, confining that consolidation yet, so still neutral. But I mean, the energy sector of the S&P, it's not going that badly, right? So again, a lot of stuff to be considered in my view. And at the end of the day, it's I think it would be fair to end up as we did last week, up until the point the momentum is completely broken. So aka these lows are broken and closed below. Probably not yet the time to go full on bearish. in order to bet for, I don't know, the next few weeks of downtrend, right? Now, again, closing in on a few reasons to be bullish and a few reasons to be bearish. Let's just have a look at this. We already checked the seasonality. That would be one reason to kind of keep on being bullish. Now, these are basically the profit margins of the tech sector against the rest of the market. And again, I think there are two ways to read it, right? The bullish one would be, well, you know, the tech sector, it keeps on increasing the profit margin. So fundamentally, the stocks should keep on going to the upside. Or again, if you want to get back to a little bit more of a balanced read, right? That would resemble like looking at the chart of the S&P and then looking at the chart of the equal weighted index. Right? And you would assess it like, also basically everything which is fueled so far this rally is just a bunch of stocks. Because at the end of the day, the other 493 stocks, they're not really seeing profit margin increasing. So, you know, that wouldn't be so good, right? Then what we got, it's this, still a measure of breadth. By the way, it could be worse now that we had a bit more of a downside move, because I guess this is from Wednesday, so previews, or just ahead of the Thursday drop. So, you know, it could be even worse than that now. But again, as you can see, the breadth of the market, if you check the overall basket of stocks, they're not really performing that well, right? Then what we got is these, which I think, again, in between what Jensen said, what Hartman said at the beginning of the video, I hinted at that. I think another problem could be that, look, expectations are a terrible thing to play with, because more often than not, they're set up to be unmet. I guess, you know, it's one thing which cuts both ways. Like many other things in market, it's like it works until it works, and it works fantastically up until the point it doesn't. And when it doesn't, the same it was fantastic on the upside, it's going to be tragic on the downside. What I mean is, look, up until the point is CapEx on the AI build-up was fueled by operating cash flow, I guess that was all well and good. But now what you see is companies like Meta and Oracle actually going into debt to finance these AI build-up. So data center and all the infrastructure and all the rest. For something which absolutely, I still think it's going to be the future, same as the internet was the future, right? It's just people didn't really see that in the moment, but, you know, it was a new technology which was made available to the general public. And of course, if you let the public, aka the free market, using a technological improvement, the free market will find creative and lucrative ways to use it and to generate profits and to create growth and wealth, right? It just needs time, right? So if you now see these companies going into debt, right? So what's going to happen first? Well, if you take on debt, right, the first thing is that from now on, you're going to have to pay interests on that. And that alone would impact your cash flow. And operative cash flow, you know, together with valuations, price to earnings, and all the rest, operative margins, operative cash flows, it's one of the things that a lot of investors, they actually monitor like a lot. This ties in with another dynamic. Think about that. If it is true, as we discussed, I think it was 3 weeks ago, that corporate share buyback on average, on net, overall, over the last 20 years, it's basically the main reason why the market is up so much. And if you consider the fact that if you subtract the amount of money being injected by corporate share buybacks, the market talking about the index, would be 40% lower, what do you think is going to happen if the free cash flow of a company is going down due to those cash flow need to be rerouted to maybe paying interest? Well, it's going to mean that the company is going to have less dry powder to buy back the shares. So it could be another thing which kind of threw a dent, at least, for now, short term, for now, in the AI mania, right? And at least got people to think about it, right? It's just a process. At the very beginning, AI is fantastic. AI is going to be the future. Look at the trillions they are putting into it. And then you shift to, okay, now instead of financing that with their own cash, the cash that they make, so their revenues, now they're going into debt, right? Now Jensen talks about China winning the air race. And Hartman is saying that, well, potentially we might need a government bailout. So, I'm sure that everything, it's kind of oriented toward bringing the government in. So then at that point, that you have infinite money to throw at it. Because I think if the US government really wants, they are going to subsidize the hell out of it. Just, this is the new space race, right? If they want, it was with Russia back then, it's with China now. And I think as a government, as a country, you want to win it, no matter the cost. So maybe these CEOs are just kind of ringing the bell like, good administration, just be aware, if we don't win, the Chinese are going to have this technology, not us. And also bear in mind that we commit billions on this thing. And if everything goes tip-top, those companies that you like a lot, the ones which are keeping the index up, making so that the wealth effect is working in a positive way, and all those 401ks are actually safe, well, those companies are going to be basically hit like a lot. So, in 08, you bailed out the banking system. It might be this time around, you need to bail out us, right? I think the narrative could be something like that. And for someone, it could be worrying, right? So that would be on the bearish side. Now again, if you want to look at the bright side, debt. Look, debt it's not the devil, right? Up until the point it is productive, it's not the devil. The problem is, and again, this is a big problem because I think nobody really knows, and I think there's no way to know it in advance. It could be the future. The problem might be, is this future going to materialize itself in 3 to 5 years, as many estimates are for now, or are we going to see the benefits of that future in 10 years? And it makes a hell of a lot of difference because, if your outlook changes, right, the bubble just popped. Like in the 2000s, there was no doubt the internet was the future. It's just a lot of people were actually early, and a lot of companies were actually early. And those companies that you see today, they basically were rising on the ashes of those companies coming before them and being early. So, again, as an investor, I think there is a lot into it, right? Now, I usually don't talk about the housing market, but this is just a nice correlation in between houses price and the trend of the housing rent. As you can see, there is a good correlation. Now, why am I bringing up right now? Now, first of all, just to show recently that both the rent growth and home prices, it came down a little bit. Right? So after that, you check the rent and you see that over the last 3 months consecutively, it kept on going down. Now, why am I saying that? Because it's not, the two things are linked, I think. Probably there is not a one-to-one correlation. And I know the Fed, it's not really looking at the home rents index, but they're looking more owner equivalent rent, I guess it is. But, you know, they are derived by the same market dynamics at the end of the day. I wanted to include that because, look, if rents are going down, you know, maybe not, again, it's not a one-to-one correlation, but you would expect owner's equivalent rent to come down, right? And that is 33% of the headline CPI index. So again, they're talking about maybe you're not going to cut in December, but at the same time, we keep on looking at signs of potential disinflation into the future. So I don't know. I keep on thinking there is no reason to keep on cutting slowly, right? We're not talking about slashing 50 basis points at a time, but, you know, as the economy is normalizing and potentially slowing down a tiny bit, it wouldn't be inappropriate to keep on cutting, right? And these should be another evidence in that direction, in my view, right? Which, again, could be good for the equity market because, again, you've seen this week what happened when they keep on, you know, pulling those cuts off the table, right? The initial response of the market wasn't good, right? But at the same time, you know, if they cut, there is a reason, and the reason is usually an economic slowdown. If the economy slows down, consumption slows down, and eventually revenues and earnings, they just, you know, disappear, and you have to reprice the stocks, right? But that is a much long-term and slow process, right? Now here, we were discussing the ADP report. And again, this is straight out bearish for me on the economy, right? So not necessarily on the market in the short term. But again, we were talking about the shutdown, the fact that we don't have data for the economy. And again, we might not have official data, but we can have private data, like Trueflation for the CPI, or ADP for the labor market, and in this case, the payrolls, right? I mean, I don't think it's particularly good. Not good at all, right? So again, it's downtrending, and it looks like the momentum down is accelerating. Case in point, I mean, don't you find strange that a lot of layoffs have been announced right ahead of festivity? Why would you do that? I mean, why would you spoil and ruin the morale and potentially the propensity to spend of the consumer by announcing layoff in a period of the year where you usually have the best, you know, sales of the year? Either you are particularly masochist or, I mean, there is nothing else you can do in order to preserve those margins, right? So that would be something that I put on the bearish side of the board, right? But again, getting back to something a bit more bullish, again, corporate share buybacks. We have already discussed that in the past and just a few minutes ago. So just look at the numbers, right? Look, the semiconductor ETF, as you've seen, this is last week, not necessarily this week. So it is curious. And again, you could read it twofold, right? Because if it is true that we had a lot of buy the dip activity, at the same time, the 3x leverage ATF on NASDAQ, I mean, there were just more than 1 billion into it. So what happens when the market goes for new lows, right? So again, leverage works and cuts both sides, right? So you could read it as, well, I mean, so people are still buying the dip, we should be safe, or people are now buying the dip, but now, you know, trying to catch the falling knives, they're losing a finger or two. So again, always two reads off of the same scenario right here. Now the sentiment, or as they call it in here, the risk appetite, it looks like it's going up a little bit, which again, a bit more of a risk appetite should bode well for the overall market. Although, standing to this week, so far, it doesn't look so. So we'll see next week, I guess. And really, I think at the end of the day, we're going to have to wait for the end of the month of November to see if we kind of respect what we're looking at in the past. When was it? At this point, probably 30 minutes ago, right? Now, let's close it down because it's been already too long. All right. So look, we'll see what the market does next week. Other than that, I think it's really the time to be nimble right now. Nimble doesn't necessarily mean impulsive, right? So just try to find the correct balance in between the two, right? And with that, I'm gonna wish you a very nice rest of your weekend. Have fun, and as usual, be nice and be cool. We're gonna talk again next week. Neil's out.
Mm-hmm. 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 Come on. Mm-hmm. Mm-hmm.